So let's get your outlook on gold now, because that's certainly what our viewers are always interested in. We had gold setting new record highs of above $2,400 an ounce. It's sort of settled into the 2,300 range. Do you have a gold outlook for 2024?
I think for 24, 25, I see 3,000 in the cards for sure. Near term, if you look at the GLD and the percentage of the GLD is above, which is a gold ETF, the percentage that the GLD is above the 200-day moving average is pretty crazy. And so I just think near term, you've had such a move that you're more likely to have a bit of a decline, but over, say, the next year and a half, 3,000, 3,500, I think it's a very high probability.
3,500 gold, high probability by mid-2025?
Yes, but remember, your better bet would be the commodity market's going to broaden out. So if you're at $3,500 gold, you're probably close to $50 to $55 silver. And so your upside from silver is a lot greater than gold.
That's exactly where I was going with this, Larry, because you are saying that silver is the place to be. You wrote in your latest report that the gold to silver ratio is breaking out in favor of silver, which is a very bullish setup for silver. So elaborate on that for us, please.
Well, we know about this solar demand for silver. We know about all the industrial demand, but central banks and investors around the world, the first thing they do is move into the mothership. They move into gold, but the higher the gold price goes, the cheaper the more attractive silver gets on a price basis. So historically, these types of big moves in gold bring lots of global retail investors into silver. And so that's one of the first things that happens, and we think that's about to happen. The next part of it is once the market knows that the Fed is committed toward an official easing cycle, that's where the money really starts to move into silver. And so in other words, if you look at 2016, where the Fed made a really big shift, even though we hiked that year, they were promising 7 or 8. They were pricing, like in 2006, 15, 16, they were promising like 8 rate hikes, and they hiked once. And so they made this huge shift. And the silver miners and the silver itself dramatically outperformed gold in that kind of regime. It's the same thing historically in the 70s and 80s. So once the Fed makes a strategic shift in where all the Fed governors are in unison talking about a softer path, that's where silver dramatically will outperform gold. And that's where this gold-silver ratio is like an 84, 85 handle. It should be in a normal, mature commodity bull market. It should be in the 60s to maybe mid-50s.
So what does that mean in terms of price for silver? We had silver approach $30 an ounce in April, back down to the $27 range. Keeping in mind that, gold has hit new record highs this year several times. Silver is still very far off from its own all-time highs. Where do you see silver going price-wise by the end of 2024?
Well, I think by the end of 24, you got a good shot at 30, 32, breakout. We had this big drawdown within the last month or so. We look back at the bear traps report. We look back the last, 20, 30 years. And at the beginning of these great bull runs in silver, you typically have these beautiful candle tops, many of them. In other words, it's the sign of kind of like a lot of hot money. As the commodity market broadens out, the hot money the capital moves from gold and other commodities into silver, and you get these kind of bursts up, spectacular drawdowns, and then higher highs. And so that's I think, and then we saw this like in early 2010. There's not late 2010, early 2011, and so we think we're in that kind of like 2010, late 2010 environment where silver has a long way to go on the upside.
Do you have a price target then?
Well, I mean, I think within say between now and 2025, 26, $40 to $50 is on the table for us. I mean, just the supply of silver relative to gold globally, and just the cheapness as a percentage of, in terms of the amount of global wealth that's in, I think, $16 trillion in gold, right? Silver is a fraction of that. And so all it takes is $1 trillion to go from gold into silver, and you've got this. There's your move from $10 to $40 pretty fast.
And Larry, what is the best way for investors to get exposure to that silver uptrend that you're forecasting?
Well, the most conservative way would be like the SLV, and then I think at the early stage of a bull market, you want to move into the juniors. So your SILJ, which is your junior miners in the silver space, your Pan American, your PAS, your Heclas. Those are your more speculative plays. And then your SIL is a little bit larger silver companies. So more conservative way to play it is through the ETFs for sure. And then, if you're a professional investor, you look at silver futures in the futures market, or you look at funds like Greenlight Capital and let David Einhorn buy the commodities for you.
All right, so you're very long silver, you're also long gold, but I want to bring it back to what you said at the top, and that is platinum, because in your latest report you wrote, take down your GLD gold long exposure and buy platinum. Tell us why you're so confident that the platinum versus gold trade is where to go.
Well, that ratio, the gold, this is the classic people moving into the mothership. All the central bankers have piled into gold because that term premium on treasuries, all term premium means is that when people trust longer dated treasuries less, when the United States becomes just a tiny, tiny bit like an emerging market country in terms of people are looking at what's happening in Washington and they trust Washington just a little bit less, that a term premium expansion, which we've seen, term premium will move money into the metals, and so that's what kicks it off, and so the platinum space is so small relative to gold. We're talking about an Olympic-sized swimming pool. That's the equivalent of all the gold that's ever been mined in the world. Platinum, you can stand in that pool only up to your ankles, as I mentioned before. But also, the last 18 to 24 months, we saw this big, huge, high-profile sales pitch about electric vehicles. And what's starting to happen now is the repair costs on electric vehicles, the operational costs, the reality of owning an electric vehicle versus a hybrid, that's now becoming much more. Well, the awareness around that pain for the consumer is much higher now, extremely. So like an explosion of hybrid awareness relative to electric vehicles. That's why we're seeing the performance of Tesla has suffered. And so what that means is if that whole life cycle, that rush into electric vehicles, if that is delayed by 10 years into a move into hybrids, and we're seeing this in some of the Japanese car makers, that means that your catalytic converters and your true, like you said before, your industrial demand for platinum and palladium is going to be around a lot longer. As the market kind of picks up on this trend, your upside for platinum and palladium is spectacular, and your gold versus platinum ratio is at a screaming buy platinum, sell gold range right now. It's the most stretch we've ever seen in the history of the relationship.
But that's a near-term play, Larry, right? As you're saying, we are seeing some disenchantment with electric vehicles and more hybrid vehicles and bringing in more industrial uses for platinum. But then, a big picture, one of the cases that you make for silver and copper is this whole decarbonization trend. So how does, platinum fit into that thesis a couple of years down the line then?
Yeah, that is a problem for platinum. And people say, hydrogen. In the case of aluminum will truly be a cost replacement for copper. And so that's where your bull case for Alcoa is pretty interesting. But you're right, that whole EV risk of if electric vehicle demand truly explodes and hybrids fall by the wayside, that's a big problem in terms of catalytic convert demand. So eventually things like green hydrogen and other technologies are going to come on, and that's your platinum demand. Platinum's a very heat resistant metal. So that's why with catalytic converters, there's such a tremendous demand for platinum and palladium. And with green hydrogen, if you think of like Caterpillar, you think of like all of these enormous pieces of equipment globally that are run on diesel fuel. You think about 20 years from now, 10 years from now, those being potentially hydrogen powered vehicles or big, huge earth moving machines that move from diesel to hydrogen, or big buses. This is going to create a whole new demand set for platinum and palladium that will be factored in over the long haul.
So given all of this and given the thesis that you've laid out for us, Larry, how should a portfolio be structured now in terms of percentage allocations? What are you looking at and for which timeline?
Well, one of the things we talk about in the book, When Markets Speak, is that your 60-40 portfolio of traditional stocks versus bonds is basically dead. And so that's a 2010 to 2020 deflationary regime portfolio. Now we're in a 40-40-20 portfolio where you want to be 40% stocks, 40% bonds, 20% commodities. Within that commodity bucket, you want to be right at this stage, you want to be pretty heavy in what we call precious metals and PGMs. And as the cutting cycle starts to take hold and where we kind of go into an economic slowdown and then start to come out, then you want to start to be really over allocating toward oil, gas, and copper. And that's where you're going to get the real economic upside. In terms of like your S&P 500, remember 1980, the last commodity bull market with a multipolar world, 49% of the S&P was in industrials, oil and gas, and materials, 49%. Today, that's close to 12, 13, maybe 14% of the last 6 months. So we see that growing from say 13 to 14% up to 30%. So we're going to see within the next 5 or 10 years, your BHPs, your Rio Tintos, your Vales are going to be a much larger percentage of the market. You know, your Chevrons, your Exxons, your Hesses, your Marathon Petroleums. So you're looking for those parts of the market that part of the market will probably at least double in terms of its composition component of the S&P 500. That's in industrials, oil and gas, metals, and materials.